What's going on, everybody? I'm Chris Noggle, and welcome to the Money School podcast. And today we're going to talk real estate. But, that's a pretty boring topic all in of itself. But we're going to talk about the rate increases that the Fed has done and the dichotomy between single-family home prices and multifamily home prices. What gives? One's going up, one's going down. Are they both in trouble? Is one better than the other? That's what we're going to get into. And I've got my friend Neal Bawa on from Grow Capitus. But before I even announce him, get a load of this. Over 1,000 investors and over $1 billion portfolio. I don't need to say anymore. He's the man. Neal, welcome back to the show.
Thanks for having me back. I'm very, very excited to be back and super excited to discuss this interesting dichotomy that we're seeing.
Me too. I talk about the economy and different cycles in the markets and how everything's playing into it. But, it has been an interesting couple of years. We go through the pandemic. That stimulates, about 5.2 trillion in new printing. Then that money gets floated through the systems and through the central banking. And then all of a sudden, surprise, surprise, we got a little thing called inflation and it runs away. But first it's transitory. Then it's not such a big deal. Then it's a big deal. Then we got to slay it. And here we are. 2024, and the man Jerome Powell says we might leave the door open for three rate decreases, and the market builds in 6. I just can't put my finger on what the heck is going on. So, let's just take a step back. I mean, because most people by now know what's going on, know what the Fed's doing, know what inflation is. Some people, this is the first time in their life they've actually witnessed this kind of thing. But, you're in the real estate space. So what's life been like over the last couple of years in your position?
Life's been hard. And I think that it's been hard because the base assumptions that we have made and the base assumptions that everyone that I know of, all of my friends have made, have not proven to be true. And when your base assumptions are not true, it messes with your cash flow. It messes with your profit projections. It messes with your head. It messes with your feeling about where you are and what you're doing and whether you should continue doing the same things or were you just suckered into these thoughts and went along with, the majority. So there's a lot of second guessing that goes on, at an individual level and even at a peer level, at an industry level. And that second guessing has been accelerating as the Fed's rate hikes have accelerated, right? Because there was a time.
Before we continue, let me take 60 seconds to tell you about Multifamily University. Are you ready to take your real estate investing to the next level? Look no further than Multifamily University. Our comprehensive resources, including guest podcast appearances, educational webinars, the Real Estate Trends Toolkit, and the Location Magic course, are all designed to make smart investing easy and accessible. Plus, with no subscriptions, no upsells, you can trust that we're always looking out for your best interests. But don't take our word for it. Check out what our satisfied customer, Carlos M., had to say. Neal's presentation was filled with invaluable information that is not readily available to the average investor. This group takes you to the elite level of investing. Join the ranks of the elite with Multifamily University. Join us at multifamilyu.com and start investing from a place of knowledge today. Not only will you have access to a wealth of knowledge from industry experts, but you'll also be able to stay ahead of the game with our in-depth analysis of market trends and potential recessions or corrections. Invest with confidence and make informed decisions based on data, not gut feel. Don't miss out. Visit us at multifamilyu.com today or click the link in the description below. And now, back to the content.
12 months ago, or maybe 13, 14 months ago, where I was like, hey, maybe they'll stop at 3.25. So, we're talking about the Fed funds rate, not the mortgage rate. So the Fed funds rate, its equilibrium point, which is very important for this discussion, is about 2%. So they like to keep the Fed funds rate at 2%, which usually keeps inflation at 2%. These two things are sort of joined together. They're not exactly tied to each other, but they're sort of similar. So the Fed wants 2% inflation and they want the Fed funds rate at 2%. That's their equilibrium rate. Now, of course, post-COVID, they went all the way down to 0, right? So they went from wherever they were in 2019, one day before COVID, I think it was a 2.25 or 2.5, whatever it was. They went down to 0. And then they kept it there for far too long, right? Hence your comment about transitory, then not so transitory inflation. And so inflation went completely insane. And then they're like, well, we can't just bring it back to our normal point, to our equilibrium point, because we have to go slay this dragon. And now that we've created this big dragon, you need a big, sword to slay it. That 2% sword's not going to work it. So here we are. The Fed funds rate is basically a range. It's actually not a rate. It's a range between 5.25% and 5.5%. So that's where the Fed funds rate sits today. And so they've basically raised it at least 5.25 points, depending upon the way you look at it. And that's raised interest rates, which are based on the Fed funds rate, maybe not 5.25 points, but they've gone up maybe 3.5% to 4%, because these two things are tied to each other, but they're not exactly going up at the same rate. And so this has meant that commercial real estate, whether that's multifamily or industrial or self-storage, they've all been kind of thrown for a loop. And then the single family market, which had gloom and doom folks saying, hey, it's going to go down a lot, it's going to go down a huge amount, has behaved completely in what I consider almost a nonsensical, unbelievable fashion.
Oh, so it's absolutely nonsensical and unbelievable, and makes no sense at all.
No sense at all, right? So for those of you that are not tied to numbers as much as I am, so when the Fed started raising rates and the rates were at zero, the interest rate that you pay when you buy a single family home was in the threes. So somewhere in the threes, could be 3.2, could be 3.7, sort of moves around, right? And today, if you're trying to buy a single family home, it's somewhere in the 6.5 range. And by the way, 2 months ago, it was 7.5. Right. So it was in the sevens. Now it's in the sixes. Why? Because there's some perception that rates might go down. So as a result, these rates, which are predictive in nature, they're trying to predict the future. They've already dropped a fair amount, maybe 80, 90 basis points, which is a little less than 1%. So they've dropped a little bit. What's fascinating to see is that as rates went up, and there were some very big rate hikes. So in 5 months, we raised rates by 3%, right? There was the portion that was ultra aggressive and fast, maybe 6 months. During that time, everyone that predicts single family prices, whether it is the National Association of Realtors or professional organizations like CoStar or lenders, big lenders like Fannie Mae and Freddie Mac, every single one of them, with one exception, said, single family prices have to go down. And the range was all the way from 5% down in a year to 22% down in a year. So the 22% guys are thinking, hey, if people, instead of paying 3.5%, are going to be paying 7%, that's double. Well, it's not like your income just doubled just because these rates doubled, right? So your ability to pay is affected. You won't get a loan, right? And if you don't get a loan, well, you won't buy. If you don't buy, prices have to come down. And so those guys are thinking 22%. The 5% guys are thinking, wait a minute. I think what will just happen is the market will freeze up. There'll be less homes that'll come into the marketplace. And because less homes will come into the marketplace, there'll be inventory issues, and that'll keep somewhat of a floor under prices. They'll go down, but they won't go down a great deal. Well, both of those guys were wrong, because here we are. Today, the average home price in the United States is 1% higher than before the rate hike started, 1%. So it hasn't gone up. This wasn't a typical, single family home goes up 5% or 10% a year. So in maybe 20 months, they've gone up 1%. So obviously there's been an impact. But no one that I know of was predicting that single family prices would actually increase, right? Because despite the fact that, the mortgages have gone completely ballistic. I mean, the average mortgage in the United States is now close to $3,000 a month. And it was, $1,500 a month, 4 years ago. So that number has just, just completely insane. And so you look at this and you go, this is bizarre, because everything that I just described did not happen in commercial real estate. As every rate increase went up, prices went down in a very nice and staggered way. You can even see 75 basis points. Oh, I see this price decline. And then okay for a while. And then another 75 basis points up. Oh, I see this price decline. It was a very nice gradual thing. So I'm trying to say, what is this dichotomy? What caused this dichotomy where one asset class behaved one bizarre way and the other one behaved completely normally? And could this ever happen again?
There's a lot to unpack there. And I was one of those people that said, there's no way single family homes and residential real estate can continue to go up. Not with rate increases like this, not with people's incomes not keeping pace with inflation and the cost of homes going up. I mean, there was just no way I could have said what happened would have happened. And you know, I know a lot of people are sitting there saying, I told you so. Usually the realtors and the mortgage brokers that I told were all wrong. They're probably sitting there laughing at me saying, oh, I told you they were going to go up. It's demand. It's demand. Demand, yes, but demand is only good when they can afford the housing. And I think the only answer I can even put my little pinky finger on as to why anything in the residential world is doing what it's doing is because people are employed and because banks are really, I mean, they're cutting back on lending, but they're really measuring so heavily on W-2 wage earners that those are the people buying the homes where, like, I know I have W-2, but I'm mostly 1099. Banks hate me. Like, I make lots of money and banks, they don't want to give me loans because I don't fit their little square box. So that's the only thing I can think. But you're starting to see the jobs market really weaken. I mean, unless you're focused on just the jobs report, which is primarily made up of healthcare and government jobs, wildly swung that way.
Right.
But I think once we start losing the employment market, you're going to start seeing residential real estate at least come back in line. But you're right, with the commercial side, it did. They're very predictable, almost like that's what you would expect would happen. The only thing that I can't put my finger on what's going to happen, and this is the scary one. I've studied lots of economic reports on the proverbial commercial debt cliff that we're about to go off. Actually, we're already going off of it. 2024 is the first real big year. If you do the math, most commercial mortgages are done with a rate lock. Usually it's 5-7 years, some are 10, and all of those are starting to mature. Some already started last year, then 2024, 25, and 26 is a doozy. And most CEOs of these companies are very concerned because if rates don't come down, they're going to be resetting it more than double the interest rate that those loans were set at. I don't think anyone has the cash flow right now to handle that with a weakening economy, with, you know, future outlooks of almost every company reporting is down, but yet the market set new highs. We didn't even hit that one. Like today, markets all new highs. Everything's good. We're a bull market. Like, nothing makes sense. But the only other time in history I can go back to is 1929, where nothing made sense then either. So, like, I don't know. I don't know where to go and what to put my finger on, but there's going to be a lot of pain somewhere, and there's going to be a lot of winners and a lot of losers.
Well, let me, you know, offer my opinion on a few of those things. The first thing is the market hit record highs, right? In every cycle, whether it's 2001, 2008, or past recessions, even the 1992 recession, the one thing that the stock market does predictably is that they hit their bottom well in advance of any other class. So real estate, any other asset class, the stock market hits its bottom first. So for example, the 2008 crisis, real estate, the lowest prices that we got for real estate were in early 2012. Most people don't know this. They guessed 2010, some people say 2009, some say 2008. But the lowest real estate prices averaged across the United States were 2012. So it took 4 years from Lehman Brothers going out of business for real estate to bottom, right? But the stock market bottomed on March 7th, 2009, 6.5 months after Lehman Brothers, right? So the stock market tends to basically hit its bottom sooner. Now, I don't know if this, you know, this bottom theory applies for this particular cycle, but there's certainly a lot of evidence that the stock market tends to hit its bottom earlier. I do think that the stock market is overpriced. And I think that the reason for that is what you mentioned, the jobs. Everyone, you know, when you read reports from the beginning of this year, they're very interesting. So you read the Wells Fargo report, you read Goldman Sachs, you read Bank of America, and what everyone got wrong is where would unemployment in the US be at the end of this year? And even that unemployment number, as you mentioned, is a little bit made up. It's at least buffed up, right? Maybe not made up, but it's buffed up. So most people believe that the US would be at 4.5 to 4.7% unemployment. We ended the year with 3.7. Now that 1% difference is massive, because a 1% difference is a huge swing in our ability to buy stuff, right? So, you know, you're looking at 220 million people in the United States, and that, you know, that are working, that are not kids or retired. And so 1% would basically be 2 million people that simply can't spend money anymore, can't pay for rent, can't pay for things. And that makes a significant difference. So a lot of the things that didn't happen this year, the stock market going down, single family not going down, didn't happen because of the fact that we didn't get that unemployment reduction that we were thinking of. 20 basis points going from 3.5 to 3.7, that's not enough. We basically were very lucky in the sense that we were able to get inflation down to 3.5%, not quite to 2, but to 3.5% from 9.3, which was the maximum. And we did it with only a small reduction, a very tiny reduction in employment, which shows that, firstly, that the economy was much more resilient than anybody ever gave it credit for. Secondly, most people should be saying this. The Federal Reserve's rates, and the Fed says this all the time to their credit, nobody listens. The Fed says when we make a rate cut, it takes 9 months for the effect of that rate cut to be felt in the economy. It takes 9 months because it takes a while for the things that happen or don't happen because of the rate cut to wind their way down to the economy to the point where less people make less money, because less people have to make less money because that's the only way inflation comes down. A reduction in inflation means less people spent less money and bought less stuff, right? Well, it takes a while for that to happen. So the Fed is basically saying, hey, the rate cuts that I made 6 months ago, well, you haven't even heard about those impacts yet. Those impacts come in the future, right? So to me, the markets are simply factoring in, oh, the Fed's done with rate cuts, yet what about the impacts? So unemployment is projected to rise again from 3.7% at the end of this year to 4.5% next year. So oddly enough, we did not see recession-like conditions. Individuals may have felt it, but as an economy, 220 people working, 330 million people that live in the US, we did not feel like this was a recession year. We spent a lot of money on capital goods. We bought cars. We spent money on vacations. Travel costs were all-time highs, and people were spending money like there's no tomorrow. That happens in 2024. So you're going to see a more anemic economy no matter what happens in 2024, because today in January, we still have ridiculously high interest rates, and rates don't have to get any higher to put pressure on the economy. The way I look at rates is a 1% increase in rates is like a 10-pound weight on your chest. Well, the Fed's got 5 of those on the economy's chest right now. So even if they don't do anything, those 5 suckers are still there. Right? So every single day they're pushing the economy downwards, and they're slowing jobs down, they're slowing down, everything, and they're obviously slowing down inflation. So the first thing is we see impact in 2024. Some of those home price losses that we saw in 2023, they've just been pushed to over a year. They're still there. And so to me, I think we see some home price declines in the next year, and I think that's likely to be in the single digit range. I still don't think that we're going to see double digit declines in home prices, even though we've seen high double digit declines in commercial real estate. Right? I haven't talked about that last bit that you talked about, but you see multifamily 20 to 30% declines, industrial low 20 declines, and office high 30 declines, and going towards Armageddon. And so they're all different. They're all sort of different from each other, and they've all had sort of different paths. Like self-storage, we've seen like a 2 or 3% decline, and there's a reason why there's self that is happening. And multifamily, which is considered to be the superstar asset class on the commercial side, the one that everyone loves and is the largest, well, 20 to 30%. So I'll unpack why that's happening, and I'll talk about why is it that I'm not as worried about these commercial loans that are coming through, this $1.5 trillion number that keeps getting thrown out in the news. I'm not hugely worried about it, and I'll explain why. But hopefully this was kind of a primer as to why 2023 we didn't see some of the things that we were expecting to see. The answer is 9-month delay.
Yeah. And I think that's important for the audience, to understand is leading and lagging indicators. You got to really get clear on them. And a lot of times what you're looking at is not the right thing to look at. I mean, you want to see leading indicators, look at logistics, look at box orders, like for packaging boxes, down significantly.
I look at shipping container costs. Yes. So shipping container costs from the port of Shenzhen to Long Beach, which is our biggest port on the West Coast, right? That shipping container cost, we peaked at $11,000 during supply chain issues. Of course, that was related to supply chain. They couldn't, get all the ships out. And shipping container costs dropped to $1,400, which is lower than it was in 2019. So we've had 30% inflation since then. But today, a shipping container was $1,400. Now, in the last few weeks, it went up because of all this stuff that's going on in the Gulf with them shooting at ships and stuff like that. So it spiked up again. But it was down to $1,400. That is a leading indicator. What that shows is not enough people are ordering stuff from China for the Chinese to be able to get back up to some kind of equilibrium post-COVID rate. They're still below, pre-COVID levels, which means that the demand is being pushed down. Well, that stuff is coming in now. If people don't buy this stuff, less people will get employed at Walmart. Less people get employed at Walmart. That'll be less people elsewhere, and eventually you start to see that knock-on effect. So we are absolutely seeing a reduction in demand at the front end. The leading indicators are showing it, but most of what the consumer sees are lagging indicators.
Yeah, every day. That's all we look at. In daily life, you're only seeing lagging indicators. And
your real estate business lives and dies by the network and the connections that you make. I mean, after all, your network, well, it's your net worth. That's what you always heard, right? If that's an area where you desire improvement, well, Private Money Club, it's for you. PMC saves you precious time and money by bringing the real estate world, well, right to you, right in the palm of your hand. So get in on the action like so many others have by going to privatemoneyclub.com and sign up.
And I think an interesting thing there, and then I want to kind of get into the real estate side and where you don't see the debt cliff, being an issue, and kind of just a little bit about some opportunities that are going to start showing their face in the multifamily. If we're off double digits, I mean, some in that chaos is a massive opportunity. But what I really wanted to talk about, number one, is, the lagging indicators that we're referring to. It's interesting because out of all the different cycles I've studied and all the different time frames I've studied, this is the longest bull run we've ever had. And also a generation that knows nothing about what a recession truly looks like, feels like, or even is. So there's a complete false sense of emotional security with the markets, with investing, that it's almost like a no lose, they can't lose. Secondarily, because of that right there, the longest bull run, and because of people focused on lagging indicators, I just think people are really getting out of control with their risk tolerances, what they're investing in. They're investing in a lot of things they don't know, like, and understand, which is going to, once this tide comes down a little more, you're already starting to see the Ponzi's come out. You're starting to see a lot of the buried troubles that come out of every boom cycle. I mean, you always get nonsense going on. I mean, like back in the last one, it was Madoff, and this one, who knows? There's going to be a bunch of them, but they'll start to show their ugly face, which will then instill fear. But I don't know if the traditional fear I'm used to when I was an advisor is going to show its face in this. I just don't see it. I don't know if millennials will know what to make of it. So that's the first thing. The second thing is, and we already hit on this. So the Fed, Powell specifically, and some people said it was irrational, came out and kind of opened the door for 3 rate decreases in 2024. Now, the market rallied on that. The market thought that was really good. I'm like, that would make a lot of sense. He's making a call, but everybody's focused over here when they should be over here. Because I think he's saying that the rates are going to come down because I think he sees this economic weakness. I think he sees the potential of a recession. And what do they do every time there's hint of a recession or slowdown? Drop rates, stimulate people to start spending again. And I doubt they're going to start printing again this early, but dropping rates, they might think can keep them, so they say, this soft landing and avoiding a recession. But I think it's all bullcrap. I think they see a recession, and I think these rate decreases are a hint that that's what they're thinking is going to happen, and they're trying to get out of it. What's your take?
I don't think that the Fed knows whether there's going to be a recession or not. I mean, the Federal Reserve's track record at killing inflation is awesome. Their record of killing inflation without getting into recessions is unbelievably bad. They managed to do it one time out of 9, and that one time they came within a quarter point of a recession. So technically it felt like a recession, but just from a numbers perspective, they just going to squeeze by, and they were at 0% growth for like 6 months, right? So even that 9th one didn't count. The Federal Reserve basically doesn't have any playbook and has never invented any methodology of ever killing inflation without causing a recession. So if this happens this time, I have to simply say it's an accident. It's the law of large numbers. It had to happen sometime, but there's no other reason why we wouldn't have a recession. We absolutely will, because the Federal Reserve's playbook is we are going to depress demand, and demand depression is the definition of a U.S. recession, right? So to me, I think they don't know. I think they don't know, but they love to hedge their bets, especially because they've got so much egg on their face from the whole transitory nonsense that they fed, and everyone bought it. Even the big banks, everyone bought the transitory nonsense. Turned out it wasn't. Or maybe if it was transitory, transitory meant 18 months, not 3. So we have seen, we've seen that reduction come down. So bottom line is this. I believe the Fed is completely on track. I think that they're going to cut 3 times, maybe 4. The Fed always wants to underplay a little bit because when they don't, the markets basically go crazy. And in this case, they said 3 and the markets thought 6. So if they had said 4, which I think is a real number, the markets would have thought 8. So unfortunately, this is one of these games where the Fed actually cannot exactly say what they're saying because it has consequences. So they always go a little bit under. So I do think that we're on track for 4 cuts in the next 12 months. But we'll see how the economy does. Obviously, it's performed better than we thought. It's been more resilient. Maybe it's going to continue to be more resilient. Who knows? I think one of the key things that you have to understand, though, is if we cut interest rates by 100 basis points this year, then at the end of the year, 1 year from now, right, January of next year, there's going to be less assets that will be distressed because that 101 basis point reduction, allows more flexibility in terms of how much of a loan you can get when you're buying assets, how much of a loan can you get when you're refinancing assets. So your situation improves every single rate cut, right? Every time they cut rates, your situation improves. So this is the point where the situation is the worst in the next 6 months, because I don't think they're going to cut anything until April, right? And so the first time you can get a cheaper loan than this is probably going to be May, right? So you've got basically the next 4 or 5 months where the situation is the worst. And a lot of the numbers that are being thrown out there are based on the worst case period. But they're not saying that, hey, wait a minute, a lot of these loans actually don't reset until the end of the year, or don't reset until the first half of 2025 or the second half of 2025. And some of the numbers even say until 2028, this is how much is due. Well, if the basic understanding is the Fed wants to get back to equilibrium, which is 2%, not 5.25%, and they will at some point over the next 2 or 3 years get back to that level, right? Then some of the distress will end. So you can't really count numbers from 27, 28 anyway. You should be looking at what is going to go wrong this year, because this is absolutely the worst year, because from the very beginning to almost the end of this year, we will have ridiculously high interest rates. So let's talk about multifamily, which I know, and I know these numbers well, right? So there's 20 million multifamily or apartment units in the United States that are not part of the mom and pop group, the single family rentals and the duplex rentals. There's 20 million apartments, right? Well, so let's assume every apartment complex in the United States is 100 and I'm going to say 200 units. I'm actually going to be fairly generous and say 200 units. So if that means there's 100,000 apartment complexes, 100,000 multiplied by 200 is 20 million, right? So there's 100,000 apartment complexes. And we know for a fact that the ones that are at risk of default are 3,000. That there's a number of 2,500 and there's a number of 3,000 from 2 different groups that are measuring it, and they're measuring it slightly differently. So one group says 2,500 properties at risk of default. The other one says 3,000. So it's very important to understand, of the total multifamily market in the United States, which I just quantified ballpark as 100,000 apartment complexes, 3,000 are at risk over the next 18 months of defaulting simply because they can't pay. The interest rates are too high. Right? And they don't have the ability to refinance because values have gone down, right? A year and a half from now, those values will go back up because multifamily values were very smooth to decline with interest rates and will be very smooth to go back up because they're simply, the values be just based on the interest rates. So interest rates go down, values will go up. It's just basic math. And we've already seen it happen in the last 12 months. So we can't really say this is not the way it goes. So the risk is really the next year and a half, because a year and a half from now, you might have 150 basis point cut, 100 basis points this year, 50 next year. And now all of a sudden that pushes the floor on the values, and the values start to go up. And at some point, some of those properties that are at risk may be able to refinance. They might have to put in $1 million or $2 million more, but they can refinance and not default, right? So 3,000 properties are really at risk. That's 3% of the multifamily market. So what does that mean? That means discounts. Am I getting discounts? Absolutely. I just put a property into contract called Midtown Ridge, about 200 units. And that property is 37% off from the peak price, right, in March 2022. Now, that peak was very short, right, because it was a very sharp upwards peak and a very sharp downwards. So if anyone's saying, really 37%? Yeah, but it's for a pointy peak, right? If you sort of look on either side, maybe a couple quarters on either side, it's really down 20%. So maybe let's use that number instead of using the 37% number, because I'm going to get in trouble for that. So they're down 20%, right? From peak-ish, not peak, but peak-ish numbers. And that's what was expected to happen because that's what we can pay. That's how much of a loan banks will give us. The thing that has not happened on the single family side is because there was no decline and everything is based on everything in the single family market is based on appraisals. Well, values didn't go down, so appraisal stayed high. Appraisal stayed high, so banks gave them more money. The banks gave them more money so they could basically afford to get the loans. And so the values didn't go down. Circular, right? But that doesn't happen in multifamily because in multifamily, the appraisals are actually based on the interest that you're paying, the mortgage that you're paying. So as the mortgage goes up, automatically the appraisals go down. That didn't happen in single family. Today, if you're looking at a property, the appraisal should be down 30%. It's not down 1%. And so you can still pay the same amount for an overvalued property. So the multifamily business and any other commercial real estate business is a business. It understands that you cannot pay as much as you did yesterday because your interest, your mortgage is higher. So it automatically reduces the price. And the way it does it is by banks refusing to give you more money. They're like, no, I was going to give you 23 million a year ago. Today, I'm going to give you 19, right? Obviously, that's going to affect the value. So as a result, we have these 3,000 properties. And I think that of them, half, let's just call them half, are going to default. But that's 1.5% of the multifamily market. So what is going to happen is what is already happening and will continue to happen for the rest of this year, which is heavy discounting. There will be properties that will be sold at 30% off. But does it create the sort of distress that we saw in 2008? Absolutely not. Let's review 2008. The total, and by the way, let's do a little more math. I'm going to get geeky for a second here. So let's say all these 3,000 properties, every single one of them is going to default. They're not, but let's assume 100% default rate. And let's assume they're $30 million each, right? So that's a very nice round median number for these 200 unit properties. Well, that's $90 billion. Well, that sounds like a lot, 90 billion. But what was the equivalent number in 2008? What was the total size of the risk in the United States for defaults in the single family market in 2008? It wasn't 90 billion. It wasn't 900 billion. It was $8 trillion, 90 times higher than the risk we have in the multifamily industry today. You see what I mean? So firstly, we can't say this is a systemic risk. That would be laughed at. $90 billion is not a systemic risk for a $30 trillion economy. Even $8 trillion, I would argue, was not a systemic risk back then, but everybody was afraid it would get worse. So we took the appropriate actions. But we had an $8 trillion problem that we solved, and we're still living with the consequences of that solution. And in multifamily, if every one of these properties is going to default, it's a $90 billion problem. That is the worst case number. All of them default, right? Well, $90 billion is still a very small, maybe 3 to 4% of the overall value of multifamily in the United States. The catch is this. Everything that I just said falls apart when you look at office. Everything I've just said falls apart when I look at office, right? So the systemic risk is not multifamily. Multifamily is we'll get lots of discounts. We will get longer due diligence. We will get more money out from sellers for repairs and maintenance simply because we have, right now purchasing power and the sellers are not in a good place. So we'll just squeeze them and get more out of it. Well, that's great. That's discounting. That's lovely and everybody loves it. But I don't think that applies for the office realm, which I think is facing a once in 100 year Armageddon.
Yeah, and I couldn't agree with you more about that. I mean, the office situation, I don't see a way out. I really don't. Between the pandemic and everything that happened, I mean, we're not going back. At least not going back anytime in the next decade, if ever. So yeah, either these people pivot and change, which is going to be costly. Some are not going to be able to, or they just face the fact of reality, and that is you're done. I mean,
Chris, don't assume that there are ways out. I mean, currently the vast majority of the office market has no way out because there is no alternate mathematical use that actually makes sense and would be supported by the interest rates even today, or even if they went down in 2 years, it's still not going to be supported, right? Because this is not an interest rate problem. Multifamily, all this gloom and doom in multifamily that we see today is because our historical occupancy in multifamily is 95. Now, during the early parts of the pandemic, when everyone had money, but the government was freely distributing it, it went from 95 to 96. Today, it's 94. So the total swing has been a 2% change in occupancy from peak to where we are today. And they're not predicting it to occupancy to go down. They're predicting that it'll stay around 94 for this year. It won't go up because there's a lot of incoming supply. So 2% change. Now look at office. Historical occupancy for offices was in the low 90s. Offices never really get up to 95% in any market. So it was, some markets were 89, some markets were 91. That's pretty good, decent numbers for offices. That's where they function, right? Today, that number has already dropped below 80% nationwide, right? Not any part of the market. And the markets that are most affected, like the San Francisco Bay Area, are currently dropping below 70%. So the numbers are so horrendous. They're so incredibly bad. Now we're talking about an occupancy swing of 10% for the nation, 20% for other markets, and continuing to go in the wrong direction. And the reason for that simply is most office leases are 5 or 10 years long. So a lot of them, a lot of the occupied offices, they don't have people in them. But companies are still paying their mortgage. They're waiting for the lease to be over before they completely get rid of the space, or they reduce it to half or reduce it to a third. So absolutely no one believes that this 80% number that has happened is the final worst case number. They know that it's going to go down further. San Francisco is actually a good one to look at because a lot of their leases were shorter with .coms and things like that. And they're below 70%. And so when you look at this isn't just an interest rate problem, because interest rate problems can be solved over the next 2 years. It's an interest rate problem compounded by an occupancy change 10 times higher than multifamily's occupancy change, which was 2%. Here we're looking at 20%. It's stunning what happened, right? Buildings are already beginning to sell, and these are, I'm going to caveat this by saying this is an extreme example. I'm trying to shock you. There's a building in San Francisco. It's actually fairly well known, and if you saw a picture of that building, you'd say, I think this is San Francisco. It's the Wells Fargo building. It's on market, right? That building was sold and assessed for $1,000 a square foot in 2018 or 2019. The building has just been sold for $200 a square foot. That is an 80% decline in value. The building diagonally opposite is Union Bank, and it was sold for a 75% decline in its value compared to 2018, 2019, pre-pandemic. Now, do I think that everything will sell for 80 or 90%? This is 70%? No, I was trying to shock you. I was trying to say, hey, in the worst market in the United States, the one that's most affected, the most overpriced properties are selling for 75 to 80% off. Probably the San Francisco market's down maybe 40% to 50% in price, maybe 40 probably, right? And there's plenty of buildings in San Francisco that have no problems, but a lot of these are new buildings. What's affected is that because buyers today, because companies today can get the best building for the price, it's the ones that are not so good areas, older looking buildings, lower ceilings. Those are the ones that are screwed. And a survey of those buildings, the ones that are affected in New York City, showed that only 3% of them can be repurposed for something else. Call it hotels, call it condos, call it multifamily. Only 3% of them can be put into another use in a way that makes money, right? Of course, you can do whatever you want if the government's giving you a handout and you're basically repurposing it. But if you need to make money and do a conversion, only 3% of New York's affected buildings can be reconverted. So to assume that there's a way out for these people is if it's false. It's just not there. Only 3% of these people will get away with reconversion. The rest of them will simply wait for values to fall 40, 50, 60% before they convert them. Because at some point, if the building is ridiculously cheap, you can convert it. But we're not there yet. All of the decline in values in office, almost all of them are ahead of us. And that's where the systemic risk is. The vast majority of that $1.4 trillion is not in multifamily. It's in office.
Wow. So what do you think's going to happen there? Who's going to hold that bag? That's a big bag.
So the banks are going to hold it, and the Fed at some point, if there's systemic issues, the Fed will come in and do what they always do. The government will come in and do what they always do. But please notice that Wells Fargo, Bank of America, Goldman Sachs, and also Chase, in the last month or two, have public disclosures writing down the value of their commercial assets by tens of billions of dollars each. So they're saying, hey, before we were simply allocating money, now we're just writing it down. We don't think that these values are going to come down. Hey, we took a $30 billion loss here. We took a $20 billion loss here. Now, individually, $30 billion is no big deal for Chase. It's not systemic. But obviously, as more and more of these happen, some of the mid-sized banks will have to start writing down their values. And those mid-sized banks, the hits that they're taking are huge. The big banks have done phenomenally well. If you look at profits for the big banks, they are skyrocketing because high interest rates equals higher profits, right? For banks, they have more gap, right? What they pay versus what versus what they have to do on the other hand, that gap increases. So profits for every major bank are up. Even the mid-sized ones are up, but the mid-sized ones don't have as much reserves. The Federal Reserve requires that the large banks keep much more reserve because they're systemic risks. The mid-sized banks have lower requirements. The Fed is nicer to them. Well, now the Fed's going back to them and saying, all of you guys need to go through, checks. We want to make sure that you are not the next Silicon Valley Bank. And as more and more of those checks happen, it takes time, and there's a lot of mid-sized banks. We're talking 2,000 banks, right? More and more are going to fail. Why? Because news will get out that XYZ bank is in trouble and their commercial real estate portfolio is worth nothing. It's shit, right? Well, once that leaks, people will pull their money out. Once people pull their money out, that bank will have a run. And these used to take weeks for runs. Now it takes hours. Silicon Valley Bank, the total run was 24 hours. Right? Because they were a technology bank and everyone was on Twitter saying, hey, pull your money out. And boom, by the end of the day, they were down 30, 40, $50 billion. And that's just crazy, right? But technology makes runs much easier to escalate, and Twitter makes them much easier to escalate because you immediately hear about it. And then you're like, I'm just going to go into my app and just move the money right now. And so nobody's thinking, hey, I want to be responsible and leave my money. And no one thinks like that. No company thinks like that. So it is likely that starting Q1 and Q2, you're going to start seeing more mid-sized banks fail. Whether it becomes systemic or not, I don't know. So far, I'm very impressed with the Fed and what they did with Silicon Valley Bank. They just had a hammer. They said, everyone gets their money back, not just a $250,000, the limit. You all get your money back. The question is, fine, if another one bank, two banks fail per quarter, they can do that. Right. And they've been, by the way, charging. So one of the things that the FDIC is doing is they went and charged all of the banks a huge amount of money because they had to pay out for Silicon Valley Bank. So they pulled some of that money back. So they're now back to a reasonable position. So I thank God that more big banks didn't fail in Q2 or Q3 or Q4 because the FDIC was running out of money. And it took a while for them to collect the money from the banks again and build up their buffer. But I think that the government would have to intervene. The Treasury would have to intervene because the FDIC isn't back to where they need to be. So a lot of this goes to bank failures are going to happen. There's no doubt in my mind. The people holding the bags are going to be the banks. That's where it comes down to. And if too many of them happen, then it becomes systemic risk. Then the Fed comes in, then the government comes in which case we're holding the bag. All of us, you.
Taxpayers. Wow. That was freaking awesome. Folks, if you're listening to this, like, what a wealth of knowledge. Now, as we kind of get to the end of this episode, I got to ask you, like, what's your mission? I mean, we kind of talked about what you were doing. We know you've got, $1 billion portfolio plus. So what's your mission and where are you going?
I've built apartments. I built townhomes. I built for rent. I built for sale. And I've bought a lot of stuff and improved it. All of these are good activities. They all help the country. And I'm a immigrant. To me, I owe this country an incredible debt. And what I came to the realization of is that I need to increase the country's stock. There's no way to get around these crazy real estate prices. Real estate shouldn't go up 10, 20% a year. It's crazy. I'm the beneficiary of it. I'm still saying it's crazy. That makes no sense. It will have it'll create other problems in the economy. It should go up, with inflation or a little bit higher than inflation. The only way to do that is to increase stock. And initially I was building apartments, and then I realized everyone living in my apartments are all these IT yuppie people, not the middle America that I really wanted to help. So eventually I realized that I had to go and build in smaller cities. So my mission is simple. I am building, and in the middle of building 10,000 townhomes, which are my replacement for single family homes, too expensive. You can't build single family homes for mid and middle America anymore. The salary doesn't work, the mortgage is too high. But these people can live in their own townhomes because no one wants to live in any of my apartments, even the brand new ones. To them, it's still an apartment. It's not a home. But the people that live in my rental communities that are townhomes, they think it's their home because they realize I'm never going to get to that point where I can buy a single family home because of the 40% increase since COVID and no decrease, right, in the last 18 months. The numbers just will not work unless interest rates come down to 2 or 3%. That's gone. Most of middle America is going to be a renter. And I don't want them to be a renter in an apartment. I want them to own a home. So I'm Mission 10K, which is mission10k.com, is a for-profit mission to build 10,000 rental townhomes. And we can only build them in mid-America markets. We cannot afford to build them in any of the super fancy markets because once again, then I'm addressing the yuppie IT people that make 100,000, not the middle Americans that make 60 to 80,000. So for 60 to 80K, I had to go to, second tier cities that have 1.5 million people or 500,000 people. So, Raleigh, Durham, Indianapolis, Kansas City, or like superstar small markets like Northwest Arkansas, Bentonville, Rogers, where Walmart is. There, the numbers work. I can make townhomes brand new, beautiful, 9-foot ceilings, granite countertops, and I can rent them out to people who make less than $80,000. That is my life's mission. 10,000. So mission10k.com.
Wow, I love it. And is that a website, mission10k.com?
It is. So there's people who are joining us simply because they love the mission, that maybe they can't invest in it. They just want to be part of it in some way. There are people that are doing evangelism because everything that I've done so far, it's for profit. I have 1,000 investors that are benefiting, but this is for profit. I can't do it unless it makes, 20% IRR, which is about 25% a year. That's how the math works. If I want to raise, money and I need to raise $800 million, I currently have $60 million in the bank, but it's not going to be, that's going to get me to 600 townhomes, not 10,000. So to raise all of that money, I need to prove to my investors and to Wall Street that it makes money. And so that's where being a data scientist helps. I'm profiling 323 markets in the United States, and 6 work for the math. Everywhere else, either construction costs are too high, or the cost of labor is too high, or the cost of land is too high. Something is too high, or permitting takes too long, or the cities want too much money for infrastructure. There's 5 million reasons why only 6 out of 323 markets work for Mission 10K, but doesn't matter. 6 work.
That's what I always liked about you. You're just pure data and you're just so knowledgeable. I remember the first time we met, the first time we met was during the pandemic when everybody was kind of just throwing their arms up and we were the 2 money guys talking about economic cycles and money. And, and you've just ran away with it. I love this project. I love it. So, folks, if anyone's interested, mission10k.com, we'll put it in the description, check it out, get behind it. If it's a cause, if it's something you believe in, this is the guy to do it with, folks. I can't say it any other way. I mean, you just heard him for the last, 40 minutes, just kind of literally dissect what's going on and almost predict what's going to happen. And, you're doing the research. I appreciate that.
Well, the prediction business is problematic. So I'm very happy that I'm not an economist.
Yeah, that's true. Most of them get it wrong anyway. Well, Neal, it's been real honor to have you back on, and I wish you all the best of the luck. We'll get this out there and get as many people from this side over to benefit that cause, because it is a good cause. People need homes, and not the homes that everybody thinks they need. Like you said, what'd you call them? The yuppie homes, the yuppie
fancy, classy apartments. No, that's not solving problems. See, it helps in a small way. But people want to live in a place that they want to call a home, backyard, front yard, dog. You can't really do that in apartments easily.
I love it. Well, that being said, folks, you heard it right here. Get behind it. Literally, this could be the next big thing. Neal doesn't make too many mistakes. He just does his homework, and that's what you should be doing. Get to know, like, and understand what you invest in, just like Neal does. Neal, anything else you want to say before we depart?
No, it's a fascinating discussion. Thank you for having me on, and hope to be back.
You will be. All right, folks, with that being said, that wraps this episode. Thanks for joining us. And until the next one, Go out there, take back control of your money, and be your own bank. We'll see you next time.